Hello everyone, welcome to another video. Today we are going to talk about accounting for bonds if bonds are sold between interest date. Okay, so here you should remember when bonds are sold between interest payment dates, the buyer pays the issuer the amount of interest that has accrued since the last payment date. What I'm trying to say, so this you will understand with the help of example. So for example, on November 1 year 1, Bland Company issues at par 15-year bonds with the face amount of $100,000. So you can look at here. So bonds are issued at par and maturity period is 15 years and your par value is 100,000. It has stated rate of 9%, which is mentioned on the face of the bonds. And if you want to calculate the interest, of course, you will apply this stated rate. You will multiply with the face amount. And interest is payable annually on July 1. So here you can note here, like on November 1, this is the date when actually as investor, when you will buy the bonds, but the interest you will receive on July 1. If you will count the month from November, you have a November, December, January, February, March, April, May, June, 30th June, because it's a July 1. So it means you have a right to receive the interest of 8 months, not for 1 year. Okay. So what we need to do here, it means, but actually you will receive the interest for full year, but you have a right to receive the interest for 8 months. So it means there is a difference of 4 months interest. So what we will do here today as an investor, we will pay the interest for 4 months to the borrower. Okay, and at the end of year we will receive that money. So this is how you will do. Let's have a look how we can solve this question. So first of all, you need to calculate the annual interest. How you will calculate? You need a face amount multiply by 9%, which is the stated rate, and interest rates are quoted in annual terms here. Okay, so it means there is an annual interest of 9,000. Okay, so here you should remember here on the next payment date, July 1, which is July 1, once the Bland company will actually pay the interest. So company will pay $9,000 to the buyer, but the buyer has a right to receive the interest for 8 months, not for the full year. So that is why the buyer therefore must pay the Bland for the time during the most recent period that the buyer does not hold the bond. It means buyer does not hold the bonds from July 1 of year 1 and November 1 of year 1, because this is the date of issuance. So these are the 4 months. If you will count the month July, we have August, September, and October. Okay, so the here the buyer will pay the interest for 4 months to the borrower. Okay, so this is how you will do if you will calculate the interest for 4 months. So you have an annual interest which is 9,000, multiply by 4 over 12, because you want to calculate interest for 4 months. So you will get interest of $3,000. Okay, for that period for which the buyer does not hold the bonds. Okay, so now the question is that how entries we will pass. Here we go. So first of all, on November 1 year 1, here we have a Bland company. Bland company is the borrower. Okay, so what we will do, he will receive the cash because bonds are issued at face value, which is 100,000, plus borrower will also receive interest for the period for the 4 months, okay, in which the buyer does not hold the bonds, which is 3,000 you have calculated here. So we will make a debit here as a borrower, debit cash with 103,000. Credit will go to bonds payable always with the face value, which is 100,000, and credit will go to interest payable of 3,000. The reason is that finally we will pay back this interest to the borrower, which we have received today. Okay, then on December 31st year 1, like this is the reporting date because you issued the bonds on November 1. So if you will count the months till 31st December, which is your reporting date, so you have a 2 months and you have to accrue the interest here. So you will make this entry debit interest expense. How you will calculate, because annual interest was 9,000, multiply by 2 over 12, so you will debit 1,500 as interest expense. Credit will go to interest payable. I mean, so it's accrued accruals. Okay, it's accrued interest, which is 1,500. Now on July 1 year 2, because from January 1 okay, the next year will start. So what entry you will do? So if you will count from January 1 of the second year, so January, February, March, April, May, June, so you have a 6 months. So you have to record the interest expense, okay, for 6 months there. And how you calculate? You can calculate annual interest, which was 9,000 here, okay, times 6 by 12, you will get half of the interest. So you will record this expense in the next accounting period, okay. And then you will make interest payable debit. Interest payable how? Because we have here interest payable credit here with the 3,000, you can look at here. And you also have a interest payable which is accrued at the end of the period is 1,500. So total is 4,500. You will make debit interest payable with 4,500, and credit will go to cash, because on July 1 actually we will pay the cash, okay, or we will pay the interest to the borrower, which is 9,000. This is how the borrower will account for. Now let's have a look if you are investor, I mean to say the buyer. So what you will do on the November 1, I'm talking about November 1, when you will buy the bonds, what you will do, you will make debit investment in bonds with the face value, debit interest receivable 3,000, because you have paid interest for the 4 months for the period in which the buyer does not hold the bonds, okay, 3,000 you have paid in advance, so you will book as a interest receivable. And credit will go to cash 103,000. Then at the end of reporting date, of course reporting date means a year end, again you will also have interest receivable of further 2 months. So you will make debit interest receivables by 1,500, and credit will go to interest income by 1,500. It's the same amount for which, of course, borrower will book the liability. With the same amount you will book the interest receivable. Now now at the date when you will receive the interest actually, which is July 1 year 2, you will make debit cash 9,000, because you will receive 9,000, okay. Credit will go to interest receivable 4,500. From where you got this one? Because you have interest receivable here with 3,000, and you also have interest receivables at the end of period with 1,500. So total is 4,500. Now you will credit the interest receivable 4,500, and credit will go to the interest income. This income is for the month of which will start from January of year 2 till 30th June of year 2. So you will record the interest income in the second year for the 6 month, okay. So this is how you will do the accounting, okay. If the bonds are sold between the interest dates, and here I have assumed bonds are sold at par value, okay. So I hope it is clear. See you in the next video. Bye bye.